The dollar doesn't have to rip higher for the world to start running out of dollars. And that acts the setup almost nobody is positioned for right now. The conflict is simple. The headline crowd keeps staring at the strong dollar to our weak dollar chart. While the real market, the one that funds trade hedges, trillions, and margin calls you at the worst possible moment, has been quietly repricing access. And the hidden detail most people miss is this. The squeeze shows up first, where dollars are borrowed, not where dollars are bragged about. Later in this video, I am going to give you a clean pressure map, where the stress prints first, what level matters, what confirms it over the next week or two, and what breaks the whole thesis if the plumbing loosens instead of tightens. Because if this one gauge keeps moving, the math changes. Let's lock down definitions, because this is where retail gets emotionally hijacked. A dollar squeeze is not the same thing as the dollar is going up. A squeeze is a funding condition. It's scarcity, or the fear of scarcity, that forces people to pay up to obtain dollars short term. Sometimes, even while the broad dollar index drifts sideways or even leaks lower, you can have a sleepy DXY and still have a violent scramble for dollars in specific corridors. A particular currency cross, a particular region, a particular funding tenor, a particular collateral channel. That's not a conspiracy. That's market structure. And that is why the first tell isn't media's dramatic spot candle on your phone app. The first tell is the price of borrowing dollars in the shadow system. FX swaps, forward points, and the cross-currency basis. That's where the real pressure starts. Here's the hidden detail, stated cleanly. The world doesn't fund itself in spot FX. It funds itself in forwards and swaps. A Japanese insurer buying US credit doesn't just buy dollars. It buys the asset and then hedges the currency exposure in the forward market. A European bank that needs dollar funding doesn't necessarily go beg for deposits. It often uses FX swaps or cross-currency basis swaps to transform its balance sheet. Corporates hedge import bills forward, funds hedge overlays, dealers intermediate. And when balance sheets get constrained because of risk limits, quarter end, regulation, or plain old fear, the price of that synthetic dollar funding jumps. That jump is the squeeze. But that's not the part that matters. The part that matters is where it shows up first and how it migrates. So let's build the pressure map. Think of this like a heat map across 5 zones. Zone 1 is the Asia funding corridor. USD, JPY, short-dated yen funding, and anything that smells like carry trade fragility. Zone 2 is offshore China, CNH, non-deliverable forwards, and offshore liquidity that can evaporate faster than any G10 market when policy leans on it. Zone 3 is Europe, EUR, USD basis, bank balance sheets, and the cost of hedging dollar assets back into euros. Zone 4 is emerging markets, countries and corporates with dollar debt, refinancing windows, and commodity import bills that have to be paid whether they like it or not. Zone 5 is the commodity and metals complex, the collateral response, the paper versus physical tension, and the way hard asset bids can appear when people stop trusting the paper promise. Watch the order those zones light up. It's rarely random. And that order tells you whether you re-dealing with a brief tremor or a real global squeeze. Now we get mechanical, because retail investors with fragile attention actually love mechanics when it S-framed correctly. Mechanics are the part of markets that don't care what you believe. Here's how institutions manufacture dollars. In an FX swap, you exchange currencies today and reverse the exchange later. On the surface, it looks like a hedge. In practice, it's a short-term loan dressed up as a currency trade. The forward rate isn't just a forecast of where spot will go. It embeds interest rate differentials, balance sheet costs, and when the system is stressed, a premium for dollar funding. That premium is the cross-currency basis. When covered interest parity breaks, it's basically the market, admitting out loud that the theoretical price is irrelevant because the constraint isn't theory, it's the dealer's balance sheet. And when dealers step back, the basis doesn't politely drift. It gaps. Because if this one level breaks, the math changes. You've probably heard people talk about the dollar index like it's the scoreboard. And sure, it matters. But right now the tape is sending a classic mixed message. Broad dollar proxies can look calm to soft even while the funding story underneath starts to tighten in pockets. We just watched a very real example of localized stress. The yen has surged hard enough that headlines are suddenly yelling again, and the dollar has dropped from around the high 150s to the mid 150s against the yen in a very short window. That's not a normal gentle repricing. That's a positioning event. That's somebody getting forced. And that's why you don't just watch direction. You watch volatility and you watch where the move came from. Because the next detail flips the whole setup. Here's why USD JPY is such a good early warning tremor. The yen sits at the center of global funding, because for years it has been the go-to cheap funding leg for carry trades and global risk positions. When USD JPY is stable, the machine hums. Borrow yen cheap, buy higher yielding assets, hedge some exposure, and call it a day. When USD JPY gets whippy, when it starts moving like a risk asset instead of a currency, it S, telling you something about leverage and hedging demand. A sudden yen surge can mean carry trades are being unwound, which often happens when risk managers reduce exposure and demand dollars to meet margin or reduce USD asset risk. But it can also mean the market is bracing for policy responses, and that alone can create violent short-term funding demand. The key is not the story you want, the key is what it forces participants to do. Now, let's talk about offshore markets, because this is where squeezes get loud fast. Offshore CNH and related structures are a classic pressure release valve, and sometimes a pressure cooker. Offshore liquidity can be tightened quickly. Forward curves can reprice quickly. Basis between onshore and offshore can move quickly. If you've ever seen an offshore funding rate spike in a moment of stress, you know the feeling. It's like the lights flicker before the power goes out. When offshore participants can't easily access dollars, they don't sit around philosophizing about long-term fundamentals. They scramble, they pay, they pull liquidity from whatever they can, and that's when you see weird stuff. Spot not moving much while forwards scream, or spot moving abruptly in thin liquidity while the wider market pretends nothing happened. And that's where the real pressure starts. Zone 3 is Europe, and this is where sophisticated investors get blindsided because they assume Europe's problem is always growth or politics. Sometimes it is. But in a dollar squeeze, Europe's problem is often hedging cost and bank balance sheets. European investors own mountains of dollar assets. The cost of hedging those assets back into euros is not some academic footnote. It can swing the effective yield by enough to change allocation behavior. When the EUR-USD basis widens, it's like an invisible tax on owning dollar assets hedged. That tax either forces investors to accept lower returns, reduce hedges, or sell assets. Each choice has consequences. If they reduce hedges, FX risk floats into the system. If they sell assets, dollars get repatriated or funding demand shifts. If they accept lower returns, the bid becomes more fragile. It's all connected, but that's not the part that matters. The part that matters is whether basis stress spreads from one corridor to another, because that tells you if this is local or systemic. Now we need the why now calendar trigger, because in FX, timing is not vibes. Timing is balance sheets. The calendar is the catalyst more often than people want to admit. Month-end fixings, quarter-end balance sheet constraints, central bank meeting weeks, options expiry, and delivery windows where hedges roll. In those windows, liquidity thins and dealers become conservative. And the same flow that gets absorbed on a normal week can blow up prices on a calendar week. And right now, you've got exactly the kind of week where multiple forces overlap. Major central bank communication risk big earnings and risk events that hit VOL and the ever-present month-end horizon that makes funding desks allergic to inventory. When balance sheets get tight, the cost of synthetic dollars can jump even if nobody is bullish the dollar. That's the twist. That's the hidden mechanism mainstream misses. Because if this one level breaks, the math changes. Let's stack proof without pretending we have magical precision. We don't need secret inventory numbers to know when the system is straining. We need observable signals. Proof point 1, the forward market and cross-currency basis commentary has been pointing to widening against the dollar in multiple crosses, especially the usual suspects like yen and Swiss franc funding legs, and implied moves in euro funding corridors. When strategists and desks start talking about a lot of action in basis, they're not talking about a pretty chart. They're talking about real funding costs moving. Proof point 2, the yen move itself, sharp enough to drag Asia equities and exporters, signals a positioning unwind and or a policy risk shock, either of which can create forced hedging and liquidity drains. Proof point 3, gold and precious metals behavior, ripping to record territory, tells you something about collateral psychology. In periods of fiscal anxiety, policy uncertainty, and funding stress, hard assets get treated like an alternative form of trust. Not always, but often. Proof point 4, the divergence between broad dollar calm and cross-market stress spikes is exactly the pattern you see when the squeeze is localized, when funding stress isn't yet a global panic. But it's starting to show up where leverage lives. Proof point 5, the calendar itself, major central bank week plus month end, raises the odds of gappy liquidity, which is when squeezes print. And that's where the real pressure starts. Now let's translate all that into behavior. Because finance isn't about being right in theory. It's about anticipating forced flows. In a squeeze, the biggest buyers of dollars are not the people who want to buy dollars. They're the people who have to. And have to comes from a short list of brutal triggers: margin calls, hedging mandates, risk limits, and refinancing. A leveraged fund doesn't buy dollars because it loves America. It buys dollars because its prime broker changes its haircut. A corporate buys dollars because payroll and invoices are due. A bank buys dollars because its short-term funding rolled at a worse rate and it needs to cover. An insurer buys dollars because its hedge program is mechanical. Those are not opinions. Those are obligations. And obligations move markets in thin conditions. This is why you can't just stare at DXY and declare victory. DXY is a basket. It's dominated by the euro. It can be flat because the euro is flat, while the yen is melting or surging, while offshore Asia is stressed, while EM is quietly repricing. A pressure map is more honest than a single index. So here's how the dollar squeeze shows up first, in order most of the time. First, you see stress in short-dated funding and hedging instruments, forward points, basis, and swaps. That's the earliest whisper. It's not on the front page because it's not sexy, it's plumbing, but it's the whisper that becomes a scream. Second, you see it in the funding currencies that sit under leverage. Yen and franc dynamics get jumpy. You see bigger intraday ranges. You see headlines about intervention risk. Because when moves are fast, policymakers get dragged into the narrative. But the key is not the headline. The key is how vol changes behavior. Higher vol forces lower leverage. Lower leverage forces position reduction. Position reduction forces currency conversion. Currency conversion forces dollar demand in some corridors. That's the chain, and that's where the real pressure starts. Third, you see it in offshore markets and basis between onshore and offshore, places where liquidity is inherently more fragile. Offshore stress often front-runs broader risk moves because it's less buffered. It's like a canary in a coal mine that also trades 24/5 with fewer circuit breakers. Fourth, you see it in emerging markets and dollar debt corridors. This is where the squeeze stops being a trader story and becomes a real economy story. If you have dollar liabilities and local revenue, a stronger funding dollar is not a meme. It's a solvency conversation. Even if the dollar index isn't surging, localized dollar scarcity can still increase refinancing costs. That bleeds into risk premia. That bleeds into capital outflows. That bleeds into spot FX. Fifth, you see it in commodities and metals, not as a direct dollar up means commodities down cliche, but as a collateral and stress response. When funding is tight, the world is not just repricing prices, it's repricing trust. Sometimes that means a bid for gold. Sometimes it means weird spread behavior in futures curves. Tightness here, glut there. Sometimes it means physical premiums that don't match paper prices. The point isn't to force every signal to agree on direction. The point is to recognize the signature of stress, divergence, spread movement, and liquidity fragility. Because if this one level breaks, the math changes. Now, I want to do a quick, simple calculation in your head, not because we're pretending to forecast decimals, but because it snaps the logic into place. Imagine you're a large non-U, S investor holding U. ASU, assets. Your return isn't just the yield on the asset, it's the yield minus the cost of hedging. If hedging costs rise because the basis widens or forward points shift against you, your effective yield drops. If your effective yield drops enough, you either reduce exposure or accept more currency risk. If you reduce exposure, that S-selling pressure in dollar assets and potentially dollars repatriated, except here AS the twist. In the short term, reducing exposure can increase dollar demand because positions unwind through dollar funding channels. People sell risk, but they still need dollars to settle, to pay margin, to close hedges. That's why squeezes can feel like whiplash. Trend and noise get inverted. And this is exactly how viewers get emotionally manipulated. So let's put the psychology shield on you right now, before the market tries to wear you down. Volatility is not proof you're wrong. Volatility is often the method the market uses to transfer assets from impatient hands to patient hands. In a dollar squeeze narrative, you will get a specific kind of emotional bait. You'll see sudden reversals, you'll see false breaks, you'll see one-day panic moves that get retraced, and you'll be told, see, it was nothing. Then the pressure returns when liquidity thins again. The trick is to separate trend signals from noise. Trend signals are persistent changes in spreads, persistent changes in funding indicators, persistent changes in vol regime. Noise is a single headline candle in a thin session. If you confuse the two, you'll make the classic mistake, selling into the very moment mechanical buying is peaking, or buying into the very moment liquidity is about to vanish. And that's where the real pressure starts. Now let S get very concrete. What do you watch this week and next week if you want to know whether a dollar squeeze is building and where it's going to show up first? Watch point 1, USD JPY behavior around recent stress zones. We've already seen the dollar trade up toward the high 150s earlier this month and then snap lower toward the mid 150s fast. In these environments, certain round number areas become behavioral tripwires. Not because they're magical, but because risk models and human attention cluster around them. If USD JPY continues to whip violently and fails to stabilize, that's a sign leverage is still being forced to adjust. If it stabilizes and vol compresses, that's a sign the first wave of unwind may be passing. But don't get complacent, because if this one level breaks, the math changes. Watch point 2, cross-currency basis and forward points in the major corridors, especially those tied to yen and euro funding. You don't need to trade basis to respect it. You just need to watch whether the cost of swapping into dollars is getting worse. If that cost is worsening while spot FX looks calm, that's the early warning. If the basis starts to normalize, that's a relief valve opening. The direction of that change matters more than the absolute number for most viewers. Watch point 3, signs of offshore stress and funding fragility. Sometimes this shows up as unusual moves in offshore FX, sometimes as dislocations between similar instruments, sometimes as abrupt gaps in illiquid hours. The point is not to become a detective. The point is to recognize fragility. When offshore markets move first and fastest, it often means stress is being expressed where it's easiest to express it. Watch point 4, gold and metals behavior as a stress barometer. We've already seen precious metals rip to record territory, and whether you interpret that as inflation hedging, fiscal anxiety, or institutional diversification, it still matters for one reason. It's telling you where trust is flowing. If hard assets keep catching a bid while funding chatter intensifies, that S is consistent with a world that S trying to move collateral into outside the system forms. That doesn't guarantee anything, but it's part of the proof stack. Watch point 5, the broad dollar index and its key support zones. If the broad dollar stays soft while funding stress rises, that's the stealth squeeze signature. If the broad dollar starts to catch a bid at the same time basis widens and USD JPY gets unstable again, that's the squeeze goes global signature. Two different animals, two different risk profiles, and that's where the real pressure starts. Now let's lay out the two scenario lens, because credibility in finance comes from admitting the market can hurt you even when you're right. Scenario 1 is the controlled pullback and retest. In this path, the yen move cools down, vol compresses, basis pressure eases, or at least stops worsening, and risk assets stabilize. The squeeze narrative doesn't vanish, but it pauses. The system catches its breath. Price action becomes choppy rather than violent. In this scenario, the pressure map shows hotspots cooling rather than migrating. Confirmation looks like calmer intraday ranges, less frantic hedging, fewer gappy sessions, and signs that funding costs are not continuing to worsen. Scenario 2 is the continuation squeeze and gap risk path. In this path, the first shock doesn't resolve cleanly. Instead, it forces second-order behavior. Vol stays elevated, dealers stay conservative, hedgers roll positions into worse pricing, margin calls increase, offshore corridors get jumpy, and spot markets begin to reflect the plumbing stress more directly, sometimes with sudden gaps that feel irrational until you remember liquidity is a feature, not a guarantee. Confirmation looks like continued basis stress, renewed violent moves in funding currencies, rising correlation between risk-off and dollar demand, and continued hard asset bids that suggest trust is being repriced. If this one level breaks, the math changes. So what are the levels and invalidations in plain English? A level is any price zone or condition that forces a change in behavior. For USD JPY, it's not a single number etched in stone. It's whether the market is behaving like a carry trade with mild volatility or like a leveraged position that's being repriced under stress. For the broad dollar, it's whether it can hold its recent range near the high 90s in DXY terms, or whether it starts to trend meaningfully in either direction. For the plumbing, it S, whether forward and basis measures continue to show widening dollar funding costs or begin to normalize. Your thesis strengthens when multiple zones on the map light up in the same direction. Funding costs rise, volatility rises, and forced flow signatures appear. Your thesis weakens when the hotspots cool. Funding costs ease, vol compresses, and the market stops behaving like it's being forced. And here's the part that will save you real money, not in the get-rich sense, but in the don't donate your account to the market sense. Even if the squeeze thesis is correct, price can whip around violently. You can get a 2 to 3 day move that looks like the thesis is dead, only for the funding stress to reassert itself on the next roll window or the next thin liquidity session. That's not failure, that's structure. Your job as a retail investor is not to win every candle. Your job is to avoid getting emotionally liquidated by noise. The market will try to make you hate your own position, even when the structure is intact. It does it with boredom, then it does it with shock, then it does it with relief rallies that bait you into overconfidence. Don't take the bait. The next detail is what flips the whole setup. Watch the plumbing, not the applause meter. Now let's connect this pressure map to the metals and commodities crowd, because this is where a lot of you live, and frankly, where the truth often leaks first. In a dollar funding squeeze, you can get two seemingly contradictory things: gold ripping while the dollar is not ripping, and industrial commodities behaving in a messy, spread-driven way. That's not a contradiction if you understand the mechanism. Gold can trade as trust collateral. when fiscal sustainability worries rise, and when global investors want an asset that doesn't T require someone else S balance sheet. At the same time, industrial commodities can be yanked around by growth expectations, inventory financing costs, and shipping constraints. The signal isn't always the headline price. The signal is often the spreads. What month is tight, what month is loose, whether physical premiums feel sticky, whether inventories look available or encumbered. Funding conditions change the cost of carrying inventory. They change the appetite of merchants and dealers. They change the behavior of ETFs and managed money. And that's where the real pressure starts. Let's also address the institutional incentive conflict without going full tinfoil. Nobody has to manipulate anything for this to happen. Incentives do the work. Dealers want to protect balance sheets. Banks want to minimize capital usage. Funds want to survive drawdowns. Policymakers want stability. Those incentives can align in a way that delays visible stress until suddenly it can yet be delayed anymore. That's why mainstream coverage often arrives after the move. They cover spot. The system trades swaps. They cover direction. The system trades access. They cover risk appetite. The system trades margin. That difference is your edge if you are willing to do the unsexy work of watching the pressure gauges. So here's your near-term roadmap, tight and usable, for the next 1 to 2 weeks. First, watch whether the yen move becomes a trend or a snapback. A stable, calmer USD JPY with lower vol supports the controlled retest scenario. Renewed violent ranges support the squeeze scenario. Second, watch for signs that hedging costs are becoming the story. If commentary and data continue to point to widening basis and stressed forwards, that's the early warning staying on. Third, watch offshore fragility. If stress appears in offshore markets during thin hours, that's a sign liquidity is brittle. Fourth, watch metals and risk sentiment. If gold holds its strength and dips get bought quickly, it suggests persistent demand for trust collateral. Fifth, watch the broad dollar S behavior around its recent range. If it begins to rally while those plumbing signals worsen, that's when the squeeze stops being localized and starts becoming macro. And let me give you a subtle but critical psychological trick the market will pull next. It will give you a day that proves the squeeze is over, usually right after it has extracted maximum pain from the crowded side. You'll see a relief move. The commentary will turn smug. People will say it was exaggerated. And then, when the calendar rolls and the funding desks reprice again, the stress comes back. The market doesn't care about your narrative consistency. It cares about clearing positions. Your shield is to anchor to conditions, not emotions. Conditions, funding costs, vol regime, spread behavior, forced flow signatures. Emotions, headlines, hot takes, one-day candles. The next detail is what flips the whole setup. If you want a simple identity rule to follow, because rules beat vibes, be the person who watches what institutions can ignore. Institutions can ignore your opinion. They can't ignore the cost of funding. They can't ignore a widening basis. They can't ignore a volatility spike that changes their VAR. They can't ignore a hedging roll that suddenly costs real money. When those constraints tighten, the squeeze shows up first in the plumbing, then in the spot, then in everything else. That's the map. And here's the quiet CTA, because I'm not going to beg you to smash anything. If you were the kind of investor who, or D, rather understand the mechanism than repeat the headline, stay close to this framework. Use the pressure map like a weekly ritual. You don't need to predict the future. You need to notice when the system is being forced. And if you want to be part of a community that treats markets like structure, not like superstition, you already know what to do. Next week, don't ask, is the dollar up? Ask, where's access getting more expensive? Don't ask, is the yen strong? Ask, is leverage being unwound? Don't ask, why is gold up? Ask, what kind of trust is the market buying? Because if the plumbing keeps tightening while the headline tape stays calm, the squeeze isn't gone, it's hiding. And when it stops hiding, it won't ask permission.